Hi, I'm Larry DeBoer. I'm a professor in the Agricultural Economics department at Purdue University and an extension specialist in the Purdue Cooperative Extension Service. And this is another in our series on local government. Our chapter today, the Tax Cap Referenda, November 2nd, 2010, Part 2. Well, as you probably know, there is going to be a referendum amendment on the ballot on November 2nd, asking the citizens of Indiana, the voters of Indiana, whether we should amend the tax caps into our Constitution. And Part 1 discussed the language that will be included in the Constitution and some of the implications of that language. What I want to talk about right now is the tax caps themselves and how they are working. We are actually operating under the tax cap rules right now in 2010. If we put them into the Constitution, we won't change the way that we operate. We will just make sure that the way that we're doing things right now actually is constitutional. So let's take a look at the sorts of things that we know about the tax caps now. Here's the amendment ballot language, and as we talked about in Part 1, what the amendment actually does is to impose limits on tax bills at 1% of assessed value for homesteads, 2% for rental housing and farmland, and 3% for commercial, industrial, real, and equipment property. It excludes from the tax caps tax rates that are passed by referendum, and it also cleans up some language about the treatment of mobile homes in the Constitution, so we can treat mobile homes as homesteads. Well, what has happened with property taxes since 2007, and these are the blue lines that you see, and also since 2009 through 2010. We say since 2007 because the tax caps are part of a very important property tax reform that was passed in March of 2008. So a comparison to 2007 says what has happened with the big property tax reform between 2007 and 2010. And what you see here are the percentage changes in the property tax bills paid by several different types of property. And let's work from the bottom up here. And we'll start with homesteads. And what we see is that since 2007, homestead property taxes have declined by quite a bit, on average across the state by 26.5%. Now, they increased very slightly in 2010 from 2009, but a very big decline since 2007. This is not because of the tax caps. The tax caps were tightened to their permanent levels in 2010, and yet homestead taxes actually went up a little bit. The big decline in homestead property taxes comes from the takeover by the state of the school general fund property tax levy and the county welfare levies. So those are no longer, that money is no longer raised with a property tax. And also a great big new deduction off of taxable assessed value that homesteads were given as a result of the reform of March 2008. The tax caps, while they have delivered some tax relief to homeowners in places where tax rates are particularly high, are not the main reason why taxes have gone down for homeowners. Take a look at apartments and non-homestead residential. Apartments are big rental housing units. Non-homestead residential are smaller rental housing units. As you can see, those property owners have seen large decreases in property taxes as well. And in this case, those reductions have been the result of the tax caps. We imposed a 2% tax cap on rental housing. And since these units are located in cities and towns where tax rates tend to be higher, they have been eligible for tax cap credits, and that has reduced their property tax bill. So apartments and non-homestead residential property have seen their taxes decline as a result of the tax caps. Agriculture, next up there, has seen tax increases since 2007. Agriculture didn't get very much of a tax break from the tax reforms of 2008, and their property, farmland in particular, is usually not eligible for tax cap credits because the tax rates in rural areas are too low for the tax caps to kick in. So agriculture has actually seen tax increases of 14.7% since 2007. Commercial and industrial property have also seen increases of about 15% since 2007. And this has occurred in part because in order to finance the increased expenditures on the state level for school general fund and the county welfare funds, the state took the property tax replacement credit program and used the more than $1 billion from that program to help fund these new expenditures on the state? Well, the business property had been eligible for those property tax replacement credits, and now those credits are gone. Commercial property did benefit from the reductions in tax rates, industrial property as well, but because homeowners were given big new tax deductions, the total assessed value across the state turned out to be lower than it was before, which meant that tax rates did not decline as much as they might have. And all of those circumstances combined increased the taxes for commercial and industrial real property. That's land and buildings. Business personal property is business equipment, and as you can see, that's seen a very slight tax decrease since 2007 and a slight tax increase since 2009. All the things that apply to commercial industrial real also apply to business personal property, the difference being that we just didn't give business equipment very much in property tax replacement credits back in 2007, and so they didn't lose as much tax relief when the system was reformed. In total, a 9.8% decline. That's the result of the increase in the sales tax from 6% to 7% that occurred in 2008. That was the additional $1 billion or so that was delivered to property tax relief. Here's a pie chart that shows where the tax cap credits actually go to. Now, tax cap credits are the device that is used to reduce people's property taxes down to their cap rates. If you get a credit, it means that your tax bill would have been higher, but it has been reduced by the tax caps. And what you'll see here is that businesses have received about a quarter of all the tax cap credits. Homesteads have received about a quarter of the tax cap credits. And rentals, residential rental property, rental housing, and farmland have received about half, a little bit more than half of all the tax cap credits. Now, farmland has gotten almost none of that. It's almost all of that has gone to rental housing. And as I mentioned, rental housing with their relatively low 2% limit and being located in cities and towns where tax rates are higher, they tend to be the big beneficiaries of the tax cap credits. Well, tax cap credits are also revenue losses for local governments, and it turns out that the losses are greatest where tax rates are $3 or more. Now, what you see down here are taxing district tax rates, and these are the tax rates that are the sum of the tax rates of the counties and the townships and the cities and towns and the school corporations and the library districts and the special districts, all added up, and that's the tax rate that any individual taxpayer pays in their taxing district. When the rate is more than $3, tax cap credits go to businesses and to rental housing and to homesteads. That is, the 3%, 2%, and 1% tax cap categories all receive tax cap credits, and the losses, on average, 18% for local governments who happen to be in districts where the tax rates are $3 and more. Where the tax rates are only $2 to $3, the tax cap losses are 5.5%, and that's partly because businesses in the 3% category are not eligible where the tax rate is less than 3%. Where tax rates are lower than $2, there are hardly any tax cap losses. The average is about 6% across the state. The types of units that are losing revenue, well, cities and towns get hit the hardest because that's where tax rates are highest. Tax rates are higher in cities and towns because in cities and towns there's an extra layer of tax added onto your tax bill. Everybody pays the county rate and the school rate and the township rate, but if you happen to live in a city or town, you also pay the city or town rate. And so cities and towns and units of government that share their taxpayers with cities and towns lose the most revenue, as you can see, almost 10% for cities and towns from these tax caps. Well, what are the effects of the tax cap referenda? Well, they are revenue losses and tax cuts, and the local governments for the next several years, should the referendum pass and the tax caps remain in effect, are going to have to become more efficient if they can possibly do so. That might mean things like consolidation or layoffs or contracting out. It may mean that Indiana residents may have to accept lower service levels, and Indiana residents will have to ask themselves, yes, we'll get a tax cut, but do we want to cut back on the services that we receive from local governments? It may also mean, and already is meaning, that local governments will start looking around for other revenue sources. So we will probably see a shift away from property taxes towards local income taxes, towards charges and fees as a way of paying for local government in Indiana. Well, that is what we have to say for On Local Government. I'm Larry DeBoer.